Good afternoon. I'm Jim Kelly, Director of the Gabelli Center for Global Security Analysis and Senior Lecturer in Finance and Economics at Fordham. It's my pleasure to welcome you all on behalf of the Gabelli School of Business. The Financial Issues Forum is a partnership which we have created with the Museum of American Finance and the CFA Society of New York. Our goal is to bring you renowned experts from many different fields to speak on topics and issues that are relevant to the economy, the market, and to you. Today's event is very special. It features Michael Gatto, author of The Credit Investor's Handbook, in conversation with Paul Johnson, the executive director of the Gabelli Center and adjunct professor at Fordham University. After their discussion, David Cowan, president of the Museum of American Finance, will join the speakers for Q&A. Please submit your questions at any time through the tab at the bottom of your screen. Attendees at today's event are eligible to receive a free digital copy of the book, with information coming to you following our event. Now I would like to turn it over to Paul Johnson, who will introduce Michael Gatto and proceed with the discussion.
Michael.
Well, how are you?
I'm great. How are you?
I'm great, thanks.
This is a treat for me. For those of you who may not know, Michael and I have been friends for a long time now. I don't know, 5 or 6 years. And we met because at a Columbia event, because we found out we're both adjunct professors at both Columbia and Fordham. We're the only ones. And the fun part of the relationship is I'm an equity guy and he's a credit guy. So we see the world from different spots. And as you'll see in this discussion, I've really come around as an old equity guy to have deep appreciation for credit and the role it plays. And there is no one better on the planet to talk about credit with than Michael Gatto. Now, we only have an hour, and I probably could spend most of that talking about his background. And I think most people would be quite impressed with all of your accomplishments. However, having Michael talk is even the best part of it. But I will indulge for a moment and give one little bit of an introduction about Michael from my perspective. Number one is he is a superb educator, foremost. I suspect he's a superb credit investor, but in my relationship with him, I really come to appreciate him as an instructor, a professor, a teacher. He brings high energy and passion to the classroom, which I think I've never seen before. He has wonderful stories. I think the best stories, war stories from investing. Now, they tend to be from a credit perspective, but from investing that I've ever heard. He obviously has 25 plus years of fantastic experience, which he brings to the classroom. And he has a wonderful sense of humor, which I'm sure will come out in today's discussion. So for me, Michael is a great educator. And the reason I know this is I had the opportunity to sit in his class a couple of years ago. And I will tell the one funny part of the story of that experience. Class started at 5:40 in the evening and was scheduled, best I could tell, for maybe 3 hours plus. And Michael would come in, we'd start precisely at 5:40, and he would say, I have no idea when we're going to end. And he didn't mean we were going to end early. And none of the students got restless, although I will admit that after we got past 9:15 in the evening, I started to get restless, and Michael was going and could have gone for a couple more hours. I think the only thing that saved us is the parking garage did close at some point, and Michael had to be done with class before the parking garage closed so he could get his car out. But otherwise, it was always a 3.5 hour unbelievable experience. And I don't think many people have had that opportunity. A lot of people at Columbia and Fordham, but not everybody on this call. But the book is, I think, really the way in. So, Michael, with all of that, I just want to jump right in. And this is a bit prompted by the publishing of your book. So I'm going to start there because it's a great platform to hear you talk about things. But I guess, what was the motivation to write the book?
Yeah, look, it's the demand for credit analysts has just continued to grow, and constantly are getting people coming to me who are young in their careers and just saying, what can I read, right? Not everyone could go to Columbia Business School and take the course. So what can I read? And I went on Amazon and I looked for credit analysis, credit books, and there was nothing that really did it well. And what I wanted to write was purely a vocational book. And this is a book that if you go, you get hired, you're working for a private debt fund, private credit fund, and your boss calls you Friday afternoon and says, I have great news, which usually means he's about or she's about to ruin your weekend, says, I have great news. This private equity firm is going to launch a takeover of this public company. We're going to get first look to do the debt financing. There's a data room set up. Go through it. Write a memo over the weekend on your thoughts on the deal. Put together a list of follow-up due diligence. Shoot it to me Sunday night, and we'll discuss. What do you do? You're the analyst. What do you do? And what I try to do is I really took Mark Twain's advice. Mark Twain, one of his famous quotes is, the secret to success is to get started. The secret to getting started is to take an overwhelming, complex task and break it into small little parts. And that's what I did. So I've broken down analyzing making a loan to a company into 7 large steps. And I go through how you do each one, and then I have you do it on your own on a real company, and then I discuss how I look at that company. So it's starting with sources and use statement. What is the financing? What is it going to be used for? In the LBO example I just talked to, it's we're going to put in debt. The private equity sponsor is going to put in equity. That's our sources, and it's going to go to make an acquisition. It's an acquisition financing. So go through what does the sources and uses statement look like. Then go through qualitative analysis. Is starting with the industry. Is it a good industry? Is it growing, mature, declining? Is there cyclicality? Is there government regulatory risk? Laying out how do you identify big pictures risks to that deal? Then going through, ripping apart the financial statements, forecasting, modeling out the future projections into valuation, and then deep dive into structured documentation. But all of that comes to then writing a memo that takes all of your work with a recommendation of whether we should do more work on this deal with a due diligence. And each chapter of the book goes through a step. We practice on a real company. And then the last chapter, and this is all in section 1, has real memos, not our fictitious memos, real memos on real deals that the reader could read and see, okay, this is what that assignment should look like if you're going to go out and make an investment recommendation. And there's no other book that covered it that way. There's books that discuss the leveraged finance market. There's books that gives you some idea of structuring, but no book has been written that just says a deal is thrown at you, analyze it to the point where you could write a memo. And that's the first section of the book. And then the second section goes hardcore distressed debt, which is looking at debt that someone else originated, made the loan, that has gone terribly wrong. And do you want to buy that debt at a discount? And given that that debt instrument is distressed, meaning the company is having problems, then you got to layer in all of the nuances of bankruptcy. How does bankruptcy work? And all of the strategic negotiations that go on behind the scene. So a really long answer to a very short question. Why did you write the book? I wrote the book because I just saw white space. No one had covered it. And if you Google investing in equities, there's thousands of books. Some great, like Pitch the in the book you wrote. Some of them great, some of them suck, but there's thousands. If you put in credit analysis in Amazon, my book comes up and 4 or 5 others, but my book is the only one that attacks it from what I would call a vocational point of view.
Yeah, that's one of the things I was going to ask you about. You've touched on it. Is in the equity world, there are classics, there are current, there are focus, there are growth, value, all this stuff. We've kind of taken the pie and sliced it 1,000 times. And in credit, and as I got to appreciate your role in that and take your class and watch you write this book, I'm sort of shocked because credit, best I can tell, is 20 times bigger than equity or something. It's huge. Every business uses credit. Most business uses equity, and there was no book. As you and I got to know each other, I said, "What should I read?" And I was faced with the same problem you just talked about with your students, and that I guess was really fascinating to me. Now, let's focus.
Just to take a second on that, but I thought about that too. But it makes sense because the retail investor can invest in credit, right? So every single person looks at, hey, I want to be an investor, and it's fun and it's interesting, but you could only invest in equities as an individual. So there's this massive demand for how do I invest in equities? Because you could go down your Fidelity account and buy Amazon, buy Google. You could buy GameStop and suck it to the hedge fund who's short GameStop. You can't do that in credit. Credit is for professional investors. There is no way a small retail person could say, oh, I'm going to go and originate $250 million loan to this equity sponsor to finance the acquisition. So I think that's the reason it's been overlooked. But now as the jobs keep getting shifted to credit, and there's real alpha in credit, and we could discuss that if you want why later, but because there's real alpha in credit, it's a much less efficient market than equity. At the professional level, there's more and more demand for people who can analyze credit investments. And that's why there's such now becoming a growth in demand. And you're starting to see universities teach it. For the longest time, every undergrad business school offered equity investing courses, real estate courses, private equity courses. Virtually none, virtually zero, had a course called Credit 101. Advanced credit. Now you're seeing universities saying, whoa, we got to catch up with where the demand for our students are, and professors looking to teach those courses, and they need a textbook.
Now, Michael, another insight that I never had, but you gave me, which is banks, which were the traditional source of loans for most companies for now 300 years, had great training programs. You went to a training program. David Solomon went in. Bob O'Shea went to a training program. Many of the people that run the financial services industry started in a credit program at a commercial bank. And I gather those are gone.
I wouldn't say they're gone as much as they're watered down, but the whole industry has changed. As you said, prior to 1990, which is when David Solomon, who's the CEO of Goldman, went through credit training. I went through credit training. Prior to 1990, the only ones that required credit training was the commercial banks. Commercial banks lent the first part of the capital structure, and they had a mentality of, we're not going to hire business students that majored in business. We're going to hire the philosophy major from Princeton, the math major from MIT, and then their first 6 months, we're going to teach them everything they know. And they had these massive training programs, of which I taught at those programs. So I became intimate with them, and they were phenomenal. Then over time, investors started to invest in credit beyond just the banks, and they would just hire away from the banks, and the banks started to water down these 6-month programs, and that also has increased the need for trained analysts. And I think the second change is the banks have become significantly less elitist. All of a sudden, they said, look, I get this poet from Princeton whose GPA is incredible. They could talk about the world. And then we train them. And then they say, yeah, but I don't want to do this. Then you go to Fordham, the Gabelli School, and you get these kids that are trained in finance. This is what they want to do. They have no sense of entitlement that the world owes me something, and they crush it. So I think what also happened is this whole philosophy of going to the Ivy Leagues and only hiring from them and a couple of highly competitive schools that meet this I don't know, notion of they're better, that all changed. And all of a sudden, the Fordhams become the target schools. And I actually think that's great. And then as the hiring from undergraduate business programs, Fordham, University of Virginia, all of a sudden, they're like, we don't need these 6-month training programs because we're no longer hiring the philosophy major, the poet. We're hiring hardcore finance who want to do it. And this is a gritty business. You should go to a grittier school. Or Columbia.
Well, be kind to your host. Michael, I know your first passion and love was teaching. I want to talk about that for a moment. But
look. My wife and my kids get offended by that. That's my first passion.
Well, because they think it should be them.
Right. Now, they're wrong. It is my first passion, but I want to be a little careful.
Yeah, but you're a very pragmatic individual. So I'm hoping you're helping them understand the reality of the hierarchy of your passions.
Yes.
Okay, good. I would think. All right. So your true passion, professional passion, is really teaching, and you've loved investing. This book brings you back to teaching on almost on a wider basis than you've been able to in your whole career, because the book is very available. It's very approachable. It's easy to read. You've got great case studies. You walk people through the whole thing. So leading the witness, I assume your hope is that this has a big impact on careers, young professionals that say, hey, credit is something that's interesting and exciting. I now have a tool to get started.
Yeah, that's right. I mean, look, I love investing. I don't think you could be good at any job if you don't love doing it. I love investing. I love the credit markets because I think, as I said before, there's real barriers to entry that allows you to get risk-adjusted returns that are really, really good. I also love the mentoring and the connectivity with young people developing their careers, especially the underdog. Everyone loves the underdog story, and that's why I'm passionate about teaching. But yes, I hope this book reaches an even broader audience. And I set up, I forgot what it is, it's in the book, or the email, like gatto@creditinvestors.com and LinkedIn. And I'll spend 2-3 hours on Sundays responding to emails and LinkedIn from a kid in Spain who read the book, So I'm hoping it gets this unbelievable traction. and that it helps someone in an interview get a job because they could talk the language, and then that individual succeeds at that job. And as I said, the industry has been very supportive. While I wrote this book, if you go to the acknowledgement page, there's 50 different acknowledgements. There's probably 150, but 50 of those are to industry professionals who have that 20 plus years of experience that I sent chapters to. I incorporated their stories, their commentary. So I also view the book as, well, I'm the quote quote author, representative of a lot of different people. It's a who's who of on the advisory side, people on the buy side, lawyers read through it. So yeah, I'm hoping it becomes this. My dream is this becomes the go-to book that helps people early in their career.
One last comment on the book. I had the opportunity, your publisher and my publisher are the same person, Bill Falloon at Wiley. And I was speaking to him last week on Unrelated, and we got talking about you, and he paid you a compliment, which I want to pass on, and pissed me off all at the same time. It was quite, and it was short. He said that Michael was the model author, and he did everything he needed to do. If he said he was going to do it, he did it. And he said it was a delight to work with him. He was a huge fan, and suggested to some effect that you were his favorite author. So I'm just saying. Now, Michael, you've commented a couple of times in your answers that there's a growth industry in credit, and that the credit markets have evolved. Can you talk a little bit about what's going on with credit? Why are we creating more jobs? Why is there more interest? Why is there more opportunity?
Yeah, look, I think go back to what you said. Every single company out there uses debt. It's very rare to look at any established business and have no debt on their balance sheet. And unlike equity, which is in perpetuity, debt matures. So you just have this natural cycle of companies have to refinance. Then after Michael Milken, it opened up the credit markets to the riskier part, the non-investment grade, both in unsecured bonds and secured debt. Then in the 1990s, the Goldmans of the world started to trade debt, not just the bonds, but the secured debt, creating CLOs. So right now, CLOs invest in highly leveraged debt, secured debt, securitize it and sell it off. Prior to the 1990s, there was no massive CLO business, so every CLO needs credit analysts. After the great financial crisis, the banks shut down the type of risk they want to hold, and all of a sudden, it opened up the door for private credit funds. So right now, my firm, we have approximately $30 billion of investable capital, and ballpark, half is in the secondary market buying distressed debt with the intent of working them out and getting the adequate returns. And almost half of it is lending in the private credit market, going directly to the borrower, negotiating it, and being that relationship long-term lender and partner to the equity sponsor or the company that the banks used to be.
Michael, if you were an undergrad at Fordham and you've taken your class and you've done this, what's the career path look like for somebody who really wants to get into credit, finds this really intellectually interesting, and you said gritty because there's a lot of negotiations go on. What's the first job, or what's the second job, or what's the career path look like?
Yeah, look, I always tell my students, your career path will be determined by luck. Like, I don't know anyone who I talk to who today goes back and says, "Oh yeah, when I was an undergrad, this was my 10-year plan, and that happened." I say, just get your first job. Ideally, get the job. I say, if you're lucky enough to put your head down, get your first job. If you only get one offer, take it. If you have multiple offers, if you have that high class problem, say, my first job, all I care about is learning and improving my resume. So where am I going to learn the most and get the most bang for my buck in my resume? I think while the hardcore joining an investment bank for that 2 or 3 year brutal analyst program, I think that's a great career move. It's brutal, but you build your resume. You go through Goldman Sachs analyst program, JP Morgan analyst program. You got there, you went through the 3 years. You've proven, and you want to stay in the business, you're proven you're hardworking and you're passionate about it, because no one would get through those 3 years. You built your resume and you saw a lot. Then either you say, this is a great path and I'm going to stay on the investment banking track, or I'm going to shoot out my resume. And you could go anywhere. If you did 3 years Lev Fin at B of A, JP Morgan, Goldman, you could send out your resume. Everyone will look at you. It has the most optionality because a private equity firm wants people credit trained. So they'll look at you. A credit fund will look at you. Advisory firms will say, okay, you know credit and you were at an investment bank. So the Perella Weinbergs, the Moles, the Houlihan Lokey, the more boutique advisory firms, away from the bulge bracket banks and investment banks, that opens it up. And then just go with what happens. Don't have a 10-year plan. Always work really, really hard. Always worry about your reputation. Your reputation stays with you. So treat everyone with respect, no matter where you are in your career. Look people in the eye and do what you say you're going to do. Be reliable. And it all works out. No one who's in this business who's been in the business for 20 years financially is struggling. It all ends up being an unbelievably lucrative business, and you just got to continually ask yourself, am I learning and am I happy?
Yeah, I think
if you're not passionate about it, find what you are passionate about.
Yeah, the people that stay in the business are the junkies. I mean, you're a junkie, I'm a junkie. We think about it all the time. You write books about it, you teach. Yeah. And I think that's true. I always thought that 3-year training program at an investment bank taught you that perfect is the goal, right? Perfect presentation, perfect models, that you're trying to get rid of errors. There's just no acceptance of junk work. And I think that training when you're young, you just carry that the rest of your life.
Yeah, but the interesting thing about that is that is great, right? Of attention to detail. The reason a lot of superstar analysts can't translate that into success on the buy side is perfection becomes a curse. You are making bets with imperfect information. You have to get comfortable. Nothing in real life is perfect. And I'm making bets with imperfect information. And what I see, it's hard to predict the success rate of a junior person going to the buy side and being successful throughout their career. Because look, if I have a junior guy modeling for me, I want perfection. But now that junior person gets promoted to pulling the trigger, they have to get comfortable with uncertainty. But I've seen a lot of people go investment banking, buy side, back to the advisory. Because they say, you know what? I'm great as an advisor. I'm not great as an investor. And you learn that about yourself and you say, go with where you're great. If you're struggling to be mediocre, rethink where you are.
Yeah.
And that's what I love about finance is once you got that core skills, you could go anywhere. Hey, I like relationships. Maybe rather than being a credit analyst, I should go on investor relations and be part of fundraising for a credit fund because I'm at an advantage. I was an analyst. I did all the work. I could talk the talk, but that's not my passion. I hate it. I love getting on an airplane and talking to people and building a relationship. So I'm a firm believer of 3-year investment bank, phenomenal, and then use that and go
find out where you're really, what your unique abilities are.
Yeah, when you're young, you could work on your weaknesses. When you get more senior, you can't work on your weaknesses. You got to be spending 80, 90% focusing on where you are great and let someone else do the stuff you're not good at.
Michael, there's this wonderful, I highly recommend that if you buy the book for nothing else, read the introduction. It was just a wonderful story of how you got to where you are. What was it? And he started as an educator in credit, and then you moved in. When did you get tested what was your first deal when you got tested in that exercise you just talked about? The model's not done.
If you don't mind, I'll even go back to undergrad. Because I think this tells a good point for younger people who might be listening. I graduated without a job. I was an undergrad. I was thinking, I didn't know anything. I was like, I'll be a doctor. That sounds like a prestigious thing. And I took pre-med courses. I was going to take my MCATs. And my junior year, I was like, I don't want to spend 4 more years in school. And I said, okay, I'll major in economics. And I went to a school that didn't have a business undergrad. So it was theoretical economics. I left school and basically I could draw a downward sloping demand curve, an upward sloping supply curve, draw a dot and go price quantity. And that wasn't a very marketable skill. And that was virtually all I knew how to do. So I didn't have any jobs. I left. I didn't get any jobs. Ended up getting offered Peat Marwick, an accounting firm, KPMG, Peat Marwick, in their executive compensation group. It's a job. Like, I graduated from college and that job was, hey, we put together reports for board of directors so they could get paid. They could pay their senior executives and say, oh, we hired someone to advise us. And how you get the information in every public company, there's proxy statements. I would just get the everyday delivered 100 proxy statement, and I would add her input. GM, CEO made this amount, made this amount in stock options. And, I want to blow my brains out. It was like I wasn't learning. I was boring. So I went to business school. Out of business school, I got one job offer. I got rejected from Goldman, Morgan Stanley. Where did I apply? Whatever job I thought was prestigious. If Goldman offered me a job, I would have taken it. Morgan Stanley, and I only got Citibank. So I said, okay, I didn't have to struggle with my decision of my first job out of undergrad and my decision of my first job out of grad school because I only had one offer. And after undergrad, it was after 3 or 4 months unemployed, living with my parents, the real hard to get a date, your self-confidence. Oh, what do you do? Unemployed, living with my parents. Oh, really? Let me give you my number. No, it was terrible, but it is what it is. Then I got to Citibank, and I went through this 6-month training, and I loved it. And I loved ripping through financial statements, and you do 3 or 4 rotations. And they said, we're revamping our whole credit training. We want to bring it to the next level. It's a little stale. Go work for 3 or 4 months with the head of training and the professionals, to see how we should revamp it. And I did that, and I got to know a lot of professional instructors who taught at all these banks' credit program. And I ended up not going into the rotation. I ended up doing that, revamping the program, leaving, and putting out a shingle of, I'm a teacher of credit, which is hilarious. I never did a deal. I went through credit program, but because it was before Train the Street, it was before these organizations did credit training, there were like 5 or 6 professional instructors who all were are very knowledgeable on credit that taught. I just said, hey, I'm going to do it too. Do you have any excess work you could give to me? And if so, you could take 30% off the top. I'll take 70%. So a massive finder's fee. And I was working around the clock teaching, because they all were turning down clients, or they would get American Express wanted a 1-week program in Bangladesh, Manila, Singapore. And these were older people who had families, and they couldn't go and say, okay, I'm going to go from here, and be away for 2 months. I was like, oh, I'll take that engagement. And without ever doing a deal, I quickly became, quote, quote, a credit expert. And then I got a call from Goldman saying, we're massively building. Goldman was an M&A and equities powerhouse. And then in the 1990s, they attacked credit, and Goldman wanted to be number 1 market share in everything they did. And if it wasn't number 1, it was number 2, or they shouldn't be in the business. And Bob O'Shea, who's a Fordham alumni, was tasked with building that business with a guy, Ed Muley. And they heard about me as a young credit expert, and I just got a random call. And I gave away my business. So Bob O'Shea, who, as I said, he's Fordham, loves Fordham. His kids went to Fordham. He was this superstar, second youngest partner in the history of Goldman. Him and Ed built and ran all the credit businesses. And I sat with Bob, and Bob said, join Goldman, give away your business. I had now a real business of teaching. And I said, okay, you know what? I'm going to do it, because I could always go back to teaching. I could never get this level of deal experience, especially at Goldman, which was the best of the best at the time. So I gave away, but I told them, but I can't start for 8 months, because I'm teaching. Like, I can't not show up, to doing 3 weeks in London for Citibank. So I went through my schedule and said, I'll take the job if you could wait. And I forgot whether it was 8 months, 12 months, because I got to, 1, teach the programs that I committed to, and I got to find people to take over my clients. So I basically gave away this business, because I didn't sell it. It was really nothing I could monetize, especially in that time frame. And really all I wanted to do was not burn any bridges with my clients. Gave it away. I'm in London teaching my last program for Citibank's credit training. It's emotional, and it's nerve-wracking, because now I'm going to go and joined Goldman Sachs credit trading desk. And Bob O'Shea calls me. And this is 1998. And that was where Russia had just defaulted on debt. Long-term capital management blew up. It was worried about the whole financial system crashing the way it did in 2008. And Goldman put on a hiring freeze, or not to do with the credit group I was going to join, but just firm-wide. And they called me and they said, oh, there's no job for you. We had negotiated a guarantee salary, a comp, a base and bonus. But the way the Wall Street contracts work is if I was there the day they paid out bonuses, my total comp would be a minimum of X. Legally, they didn't have to pay me a penny because I didn't even join. So Bob called me and said, look, man, I'm sorry. We got a hiring freeze. We don't know where the world is going. We're hunkering down. You should stay teaching. And I was like, what do you mean stay teaching? I gave away my business. And I was and my wife had just told me she's pregnant, which, I was happy. But I was saying, okay, move back in with mom and dad and pregnant wife, unemployed, wasn't a good look for me. So I ended up negotiating with Goldman. And I said, look, so Goldman said, but look, we're honorable people. There's no job for you, but we'll pay you 50% of your guarantee, and you don't even have to work a day. So it's a windfall. And I ended up negotiating with Goldman because I didn't have anything, of saying, but that's a silly economic deal. Rather than pay me not to work, I'll work for 6 months for half my guaranteed comp. And at the end of the 6 months, no harm, no foul. If the world hasn't improved, if you have no need for me, I'll leave. And they were like, no, we can't get the head counts. We just want to pay you the 6 months for you not to show up. But I wouldn't take no for an answer. And I ended up saying, okay, if it's about head count, I found this out through the receptionist who was a temp employee, what temp agency she went through. And Goldman used that temp agency to hire temporary receptionist, administrative. And I cut a deal with that temp agency that they would pay them the money. I would be a temp through their Goldman approved temp agency, and I would lose X% of my comp, but not that much because my comp was high enough that the agency did nothing. And I ended up cutting a deal that at 6 months, I worked at Goldman Sachs through this temp agency, and then at the end of 6 months, there was a job for me and everything worked out. But I think that whole long story is sort of a message of put your head down, work really hard. When things go wrong, don't panic. When Goldman called me, I panicked. I definitely panicked. I cried. I was like, oh my God, pregnant wife, not a ton of savings. I gave away a business. I told people I'm going to go work at Goldman. This is going to be embarrassing to me. Getting fired before you start. That was basically what happened. And then I just said, no, I'm not allowing this to happen. And I went hard because they were dealing with a lot, the whole institution. Every bank was. It ended up working out fine for everyone. It didn't turn into an 2008. But at the time, they didn't know whether long-term capital was going to create problems for all of the finance or in the whole finance industry. And I was relentless, and I made it personal to Bob, Ed. I was like, I gave away a business. You got to put me in a seat, and I'm not asking. I'm doing it for free. you're going to pay me this amount of money not to show up. All I'm saying is give me a seat. And if at the end of the 6 months, you're not begging me to stay, no problem. But if you don't do that, how do you look yourself in the mirror and say, we treated this kid, because I was a kid at the time. I was, late 20s. How do you look yourself in the mirror? And I went hard. And when I found the temp agency and I did all the legwork, they said, fine. I went. I worked for Ed Muley and Bob O'Shea. Goldman went public. They made $1 gazillion. It's in the public domain. They retired each independently. They launched Silver Point. And I said, it. I'll leave Goldman and join them. And I did it. And it's 25 years later at Silver Point. And we went from 120 million on day one to 30 billion today.
Michael, maybe the most success story in finance I've heard, where it started as a temp job as a receptionist. I think that's impressive.
I wasn't a receptionist.
Oh, I missed that part of the story.
I wasn't a receptionist, but I went through the same temp agency as the receptionist.
Michael, I would talk to you all afternoon. However, I think it's time to open it up to questions. I think David's going to join us and help me with the questions from the audience. There's David.
Hi there.
Hey, David.
Very entertaining. Thank you very much. That was a great story. A few questions and to our audience, again, as was just mentioned, please put your questions into the feeds, the chat, and we'll ask them. You have incredible endorsements on this book. Seth Klarman, Howard Marks, David Solomon, as you mentioned on the intro, so many different acknowledgments. Any anecdotes you can share with interacting with all these legends? And then secondly, was Bob O'Shea a mentor, or are you just entirely self-taught on all of this?
Well, Bob, let me start with Bob O'Shea. Like I said, Bob O'Shea in the Goldman was a legend. He was 29. He made partner. He built out the bank loan trading desk. And before him, Goldman wasn't involved at all. Ed Muley, who is a co-founder of Silver Point, was also massively successful at Goldman. And I got hired by both of them because between the two, they ran all of the credit businesses at Goldman. And I would say, Bob and Ed have been great mentors of me. And I couldn't be more thankful for them, even though they were the two people who 5 years ago were like, oh, by the way, no job for you, good luck. But it all worked out well. But as Paul has said, I've been in the business for 30 years. And when I wrote the book, I was constantly sending out chapters. It was a joke of every business email ended with, oh, by the way, I'm writing a book. I've attached 2 chapters. Can you do me a favor? Read it and comment it on it. And through that, then some of these people gave me it. And then I reached out to David Solomon, who's the CEO of Goldman. We overlapped. In fact, Bob had brought David in from Bear Stearns, and I asked him, hey, would you write the forward? I knew his story, and he was very gracious, but he had someone senior in Levfin read it. Seth Klarman from Baub, who runs Baub Post, his general counsel was Silver Point's general counsel. We did a ton of deals. He told Seth, what do you think? Would you do this? And Seth said, I will not write a back cover testimonial unless I read it cover to cover and I think it's great. So tell Michael he should assume I'm not going to do it. But get a copy of the book and I'll read it. And he read it cover to cover. He would not write a testimonial. And Howard, as I said, gave us comments, or Ellen Carr, who edited the book, knew Howard better than I did. She introduced us. He gave us a bunch of comments, only read, I think, The Distressed Dead. But yeah, it's a who's who, the back cover. And clearly Mario Gabelli sent it to him. He read a bunch of chapters. And he's an equity guy, but he, like Paul said, equity investors should understand credit. And I think he ended up buying books for everyone on his trading desk.
Yeah, I think that's the important thing. I think if you're an equity person, equity is sub to the debt. So being a credit analyst is the step to being a good equity analyst. Because if the credit's not good, the equity is not going to be good. So understanding that layer of the cap structure, I think, is critical.
Yeah, I think it's very helpful. I agree.
That's certainly what I appreciated. One of the questions that came up is the kind of an extension of an earlier question. You talked about how the credit markets have morphed. Now we have this shadow banking market, which sometimes, if the politicians say, they make it sound like it's this hidden dark area, but it's really adding liquidity to credit. You have people like Silver Point doing direct lending now to institutions, all the way from high grade to lower grade credit. Talk a little bit about how that's evolved and you think will continue to evolve.
Yeah, look, I think for senior secured debt, to fund a leverage buyout or fund non-investment grade companies, there's going to be two sources. Three sources. There's going to be for commercial banks who make the loan and hold it. That's shrinking. The regulators don't want commercial banks to take on risk on their balance sheet because, as been proven over and over, if the commercial banks go make bad loans, the government has to bail them out. And commercial banks use a tremendous amount of leverage. So every mistake is compounded by the amount of leverage. So then you go, if the commercial banks' market share is going to shrink, then it gets broken into the broadly syndicated loan market, which is the banks are the face of the company or the equity sponsor borrowing the money, but they sell it down to investors. That works for a lot of deals, but not all deals. Then there's deals where the borrower just wants to deal with one person, not with a bank that then's going to syndicate it, and then they have 100 lenders in their facility. They just want to go to one person, one institution, negotiate the terms, and not have to deal with multiple parties. And that's where the private credit fits in. There's more certainty of close, ability to act quicker, and it provides a real benefit for certain things, certain transactions where the borrower will pay a premium. I don't think the government gets that worried about it, because if Silver Point makes a bunch of bad loans, we don't need to get bailed out. They'll let us fail. So, and we have all our net worth, or a huge amount of our net worth, in our funds. So we think about everything as an investor. And the private credit firms, on average, don't use a lot of leverage. They're one-to-one leverage. So that doesn't take down the whole banking system relative to how the commercial banks finance their assets. So I think the world now, the senior secured non-investment grade lending will be commercial banks, broadly syndicated loans, and private credit, and market share will shift depending on what's going on in the world.
Thanks. Our good friend Miles Thompson wants to know what's coming next. Are you going to write another book? What are you up to?
I thought Miles retired.
Yeah, but he's of course
But
security.
it's still, I'm working on edition 2 to the book, so I don't think writing the book. I work full time, so it wasn't like I'm a full time academic and author writing a book. Writing this book almost cost me 50% of my net worth.
That's because his wife was not.
Yeah, because my wife was like, "This is bull." Like you work all the time, and now every weekend, every night, you're like, "Oh, I'm writing." She was like, finish this book up and stop this nonsense, or I'll call a divorce lawyer. And I've done well. 50% of my, I love my wife and all that, but also 50% of my net worth. I ain't making that much money on this book. So I don't think I'm going to write another book for a while, but I'm working on edition 2. Professors want problem sets. I want to add in problem sets. I didn't tackle the international market. My book is very US based. It's been selling around the world. I want to bring in some more international case studies, different bankruptcy regimes. So yeah, I'm going to definitely do edition 2, which is in the works. I did have someone reach out to me about writing a book on negotiations, because a big job, the part of my job is negotiating, especially on the distress side. And that's intriguing to me, but I just have, the constraints of 24 hours in a day. But it wouldn't shock me if a year or so from now said, yeah, I'm going to do that.
Michael, I think you showed no foreshadowing in your negotiating abilities when you got your job at Goldman. I think that was
my first big negotiation.
Right, first big credit
sure.
trade, first big negotiations.
For sure.
Paul, you want to take one?
Yeah, we're a little bit tight on time. We're almost out of time. As we go, we try to keep this exactly to an hour. Michael, I guess the last one is kind of back to you're being an educator. You and I hang out with students a lot, but can you boil down one or two things you wish you had been told, maybe coming out of undergrad or coming out of business school, that really helped you in your career long term?
Well, yeah, I mean, I'll take that as, what advice would you give?
Yeah.
I think first and foremost is your reputation. We live in a world of, in finance, 1 degree of separation. If I don't know you, if I go to my core list of contacts, someone on that list will know you, and your reputation lives forever. So I think I touched upon this earlier. First thing is your reputation. You got to be hardworking and honest. That is key. And 2, to keep the anxiety to a healthy level. Anxiety isn't bad. Anxiety motivates you. It forces you to stay up an extra hour. Anxiety is not a bad thing. The fight or flight happens for a reason. But if it gets too overwhelming, it becomes debilitating. And hardcore undergrads in business tend to be very type A and tend to worry about how they're doing relative to their friend that is doing better than them. They sort of ignore all the people who life is tough, things aren't going well, and they spot their one person they know doing better to them, and it'll drive them crazy. It will create anxiety. I wish earlier in my career I kept the anxiety to the healthy level and not let it get to the point of where it actually started to have diminishing returns. There were points where I just said, I'm dumber than everyone. I'm a fraud. I'm lucky. I'm in this seat. And as I get older and wiser, a lot of that was driven by looking at too much concern about my career relative to everyone else versus saying, I'm doing great. I mean, so those would be my advice.
Great. Well, unfortunately, I think we're out of time.
Awesome.
This was great. Michael, thank you. Thank you for sharing your time.
Well,
We know
Paul,
you're very busy. And
as you said, we've been friends for a long time. I always enjoy talking to you. I loved your book, Pitch the Perfect Investment. And David, we met for the first time through this, but I greatly enjoyed our chats.
Our pleasure. So on behalf of the museum, thank you, and Fordham. Our next virtual event, June 18th, Paolo Zanoni on Money and Promises, 7 Deals That Changed the World. Thanks again, Michael.
Thank you. Bye-bye.